Something unusual just happened in the silver market, and almost nobody is talking about the part that actually matters. Everyone is watching the price. Almost no one is watching what's happening underneath it. When silver moves through a level that traders have been quietly watching for weeks, the price move itself is rarely the story. The story is what forced that move to happen. And when you start pulling on that thread, you find yourself looking at something most retail investors never think to check: the physical mechanics of the exchange, where the price is actually made. Most people assume the silver price comes from supply and demand for silver bars and coins. That's true in the long run, but it's not what sets the price day to day. The price you see quoted everywhere, the number that shows up in every headline, is set primarily on a futures exchange, where contracts representing silver change hands far more often than the metal itself does. That distinction sounds technical, almost boring, but it explains why a price level can break the way it just did, and why the exchange itself has stayed quieter about the details than usual. What actually happened is worth separating from what it means, because that distinction matters for the next 40 minutes. The fact is, the silver moved decisively through a price zone that had acted as resistance for a long stretch of time. That's observable. Anyone can look at a chart and confirm it. What's not a fact, what's interpretation, is what that move means for where silver goes next. Interpretation requires context, and the context here is unusually rich because this breakout didn't happen in isolation. It happened while a specific corner of the market, the delivery and inventory mechanics of the COMEX exchange, has been sending signals that are easy to miss unless you know where to look. At first glance, a price breaking at technical level seems like a simple story. Buyers overwhelmed sellers, the level gave way, momentum traders piled in, and the price kept moving. That's the textbook explanation, and it's not wrong, but it's incomplete. It explains the mechanism without explaining the cause. Why did buyers suddenly overwhelm sellers at that specific moment? Markets don't move for no reason, even when the reason isn't obvious from the price chart alone. To understand the cause, you have to understand what silver actually is structurally as a commodity. And silver is stranger than most people realize. Unlike gold, which is overwhelmingly held for investment and monetary purposes, silver lives a double life. A significant portion of annual silver demand comes from industrial use. Electronics, solar panel manufacturing, medical applications, and a growing list of technologies all consume physical silver that doesn't come back. Gold that's mined tends to stay in the worlds above, ground stockpile essentially forever, moved from vault to vault, from central bank to jewelry box and back again. Silver gets used up, it goes into a circuit board or a solar cell, and it doesn't return to the market. That single difference changes a lot about how silver behaves compared to gold, and it explains why a broken price level here matters more than it would for other assets. That matters for supply too. If a meaningful share of new silver production is consumed industrially every single year, then the pool of silver available for investment, for coins, for bars, for exchange-traded funds is smaller than the total mine supply would suggest. That's not new. It's been true for decades. But it becomes especially relevant when investment demand rises at the same time industrial demand stays strong or grows, because now two sources of demand are competing for a shrinking slice of available metal. That's the setup. A description of market structure rather than a prediction. What happens next depends on what triggers investors to actually show up. The COMEX mechanics matter here, and this is the part almost nobody outside professional trading desk pays close attention to. The COMEX, the primary U.S. futures exchange for silver, publishes daily warehouse data. That data separates silver sitting in COMEX-approved vaults into two categories: registered silver, which is metal that's been certified and made available to satisfy a futures contract if someone actually demands physical delivery, and eligible silver, which meets the exchange's quality standards but hasn't been formally registered for delivery. The distinction sounds like paperwork. It isn't. It's a measure of how much silver is actually ready right now to leave the vault and go to someone who insists on taking physical possession instead of just holding a paper contract. Most of the time, almost nobody asks for physical delivery. The vast majority of futures contracts get closed out or rolled forward before they ever reach that stage. That's completely normal, and it's one of the reasons the futures market can function with a relatively small pool of registered metal supporting a much larger volume of paper trading. The system works because delivery demands are rare. But rare doesn't mean impossible, and when registered inventories start declining while trading volume and open interest, meaning the total number of outstanding contracts, stay elevated or rise, it creates a structural tension. More paper claims, fewer physical bars standing behind the ones that could actually be called. This is where interpretation has to be handled carefully, because this exact dynamic gets exaggerated constantly in less careful corners of financial media. Declining registered inventory does not automatically mean a supply crisis is imminent. Exchanges have mechanisms to encourage eligible silver to be reclassified as registered when needed, and history shows the system has flexed to accommodate delivery demands before without breaking down. The honest, evidence-based position isn't the system is about to collapse, it's that inventory data is a real signal worth watching, one that reflects genuine tightness in the deliverable supply chain without being proof of an imminent crisis. Professionals watch this data because it's one of the few objective, quantifiable measures of physical market tightness that updates daily, an actual count of bars in a vault rather than sentiment or a chart pattern. Why would registered inventory decline in the first place? There are a few plausible explanations, and a careful analyst should walk through each of them rather than jumping to the most dramatic one. The first is simple profit, taking by entities that own registered metal and choose to sell it into a rising price, converting it from an inventory line item into cash. The second is industrial buyers, who under normal conditions source silver through different supply chains entirely, occasionally turning to exchange, registered stock when their usual suppliers can't meet demand fast enough, particularly during periods of strong manufacturing activity. The third, and the one that gets the most attention, because it's the most consequential if true, is investors and institutions actually standing for delivery, meaning they hold futures contracts to expiration specifically to receive physical silver rather than cash settlement, often because they want metal in a vault rather than a claim on a counterparty's promise. Distinguishing between these three explanations from the outside is actually quite difficult. The exchange doesn't publish the motivations behind withdrawals, only the totals. This is exactly the kind of nuance that gets lost when headlines compress a complicated situation into a single alarming sentence. The responsible approach is to say plainly that declining registered inventory is consistent with all three explanations, that the data alone can't tell you which one is dominant, and that the price action itself, combined with delivery notices and the behavior of large traders as reported in weekly government commitment of traders data, gives additional clues worth examining together rather than in isolation. That raises an even more important question. If inventory alone doesn't tell the whole story, what does the price action layered on top of it suggest? This is where the recent breakout becomes more informative than just a chart curiosity. When a price level breaks with rising volume, and when that break coincides with tightening physical metrics rather than happening for purely technical reasons, like a chart pattern completing with no fundamental change underneath it, the move carries more weight. It suggests the breakout wasn't just momentum traders chasing a signal. It suggests underlying demand was already building pressure against a supply constraint, and the technical level breaking was simply the moment that pressure became visible on the price chart. Technical analysis and fundamental analysis aren't really separate disciplines when you think about it carefully. A chart is just a visual record of every buyer and seller's decision. When those decisions start clustering around real scarcity, the chart reflects it even if the chart itself can't explain why. Silver has been through moments like this before, and history, while never a perfect predictor, is useful for calibrating expectations. The most famous historical episode is the Hunt brothers' attempt to corner the silver market at the end of the 1970s, when concentrated buying pushed silver to extraordinary heights before regulatory intervention and margin requirement changes brought the price crashing back down. That episode gets referenced constantly in silver commentary, often as either a cautionary tale about manipulation or, less usefully, as evidence that any silver rally must be artificial. Neither framing is particularly accurate for today's market. The Hunt brothers situation involved concentrated buying by a small number of actors specifically trying to control supply. What's happening in today's market, if the inventory and industrial demand data are read correctly, looks different. Broader based demand from multiple sources, including industrial consumption that simply didn't exist at anywhere near today's scale in that earlier era, since solar and electronics demand for silver are largely developments of the last 2 decades. A more useful historical comparison is silver's run in 2011, when the price approached levels not seen since that earlier Hunt era spike, driven by a combination of investor demand following the global financial crisis, a weaker dollar, and expectations around central bank policy. That episode is instructive not because it predicts what happens now, but because of how it ended a sharp, fast reversal once speculative positioning became extreme and margin requirements were raised, which increased the cost of holding leveraged long positions and triggered forced selling. The lesson from 2011 isn't that silver rallies always end badly. The lesson is that when a rally becomes heavily dependent on leveraged speculative positioning rather than physical demand, it becomes vulnerable to sharp reversals triggered by exchange or regulatory actions that change the cost of maintaining those positions. That's worth watching for, and it's checkable using the same commitment of traders data mentioned earlier, which shows how much of the futures market is currently held by speculative traders versus commercial hedgers. Is today's setup more like the structural, industrially driven tightness argument, or more like a speculatively extended rally vulnerable to a 2011 style reversal? Based on publicly available data, elements of both are present, and a careful investor should hold that ambiguity rather than forcing a simple narrative. Industrial demand for silver, particularly from solar panel manufacturing, has grown substantially over the past several years as global renewable energy installation has expanded, and that's a demand source that doesn't disappear based on sentiment, because manufacturers need the physical metal regardless of what the price chart looks like. At the same time, speculative positioning in silver futures can and does swing to extremes periodically, and elevated speculative long positioning has historically preceded sharper pullbacks, not because the underlying fundamentals were wrong, but because leverage positions are inherently more fragile and prone to rapid unwinding when sentiment shifts. Silver doesn't trade in a vacuum, though. It trades in relationship to the broader macroeconomic environment, and that relationship goes a long way toward explaining why this particular moment stands out. The most important macro variable for precious metals broadly is the real interest rate, meaning the nominal interest rate minus the rate of inflation. This concept trips people up initially, so it's worth taking a moment to explain why it matters so much. Gold and silver don't pay interest or dividends. Holding them has an opportunity cost because you're giving up the yield you could earn holding a bond or a savings account instead. When real interest rates are high, meaning bonds pay a return that comfortably outpaces inflation, that opportunity cost is significant, and precious metals become relatively less attractive compared to interest-bearing assets. When real interest rates are low or negative, meaning bonds barely keep up with inflation or actually lose purchasing power over time, that opportunity cost shrinks or disappears entirely, and precious metals become comparatively more attractive because you're not sacrificing much by holding an asset that doesn't pay yield. This relationship explains a huge amount of gold and silver's price history, arguably more than any single other variable. It's why precious metals struggled through periods of aggressively rising real rates and performed well during periods when real rates were falling or deeply negative. So when you're trying to understand why silver might be breaking out now, one of the first things worth examining is what's happening to real interest rates, and specifically what the bond market is pricing in for future central bank policy. If markets are increasingly pricing in future interest rate cuts, that alone can be a powerful tailwind for precious metals, even before any of the inventory or industrial demand dynamics come into play, because falling expected real rates reduce the opportunity cost of holding non-yielding assets across the board. There's another layer here worth unpacking, and it connects directly to something every investor has heard about, but few people think through carefully: the relationship between the US dollar and precious metals prices. Gold and silver are priced globally in US dollars, which means their price, all else being equal, moves inversely with the dollar's strength against other major currencies. A weaker dollar makes dollar-priced silver cheaper for buyers using other currencies, which can increase demand from international buyers, while a stronger dollar has the opposite effect. This isn't a minor technical detail. Currency moves can amplify or dampen the effects of everything else discussed so far. If real interest rates are falling and the dollar is simultaneously weakening, those two forces compound each other, creating a more powerful tailwind than either would produce alone. If they're moving in opposite directions, they can partially offset each other, which is one reason precious metals prices sometimes seem to defy expectations based on a single variable in isolation. Markets are always the net result of multiple forces pulling simultaneously, and treating any single explanation as sufficient is usually a mistake. Who actually benefits when these conditions align, and who's exposed if the setup reverses? Thinking through market participants, rather than just abstract price levels, tends to clarify what's really going on. Long-term physical holders of silver, people who bought bars or coins specifically as a store of value rather than a trading vehicle, benefit from sustained price appreciation without needing to time anything precisely because their holding period is measured in years rather than days. Mining companies with silver as a primary or significant secondary product benefit disproportionately from price increases because mining costs are largely fixed in the short term, meaning a rising price flows almost directly to profit margins rather than being partially absorbed by rising production costs. This is why silver mining equities often move with more volatility than the metal itself in both directions. On the other side, industrial users of silver, companies that need the metal as a manufacturing input, face rising input costs when prices climb, which can compress their margins unless they're able to pass those costs on to customers or have hedged their exposure in advance using the same futures market being discussed throughout this analysis. It's worth pausing on this because it's an underappreciated dynamic. Rising silver prices aren't purely a story about investors getting rewarded. They also represent a real cost increase for an entire segment of the industrial economy, and how that segment responds, whether by absorbing costs, passing them along, or seeking substitute materials where feasible, becomes its own feedback loop that can eventually affect demand and, in turn, price. Leveraged speculative traders represent a different category of exposure entirely. These are participants using futures contracts with borrowed capital, essentially amplifying their exposure to price moves in either direction. When a market moves favorably for them, gains are magnified. When it moves against them, losses are magnified just as quickly, and margin calls can force position closures at exactly the worst possible moment, which is part of why sharp reversals in commodity markets often happen faster and more violently than the initial rally that preceded them. Understanding that this category of participant exists and that their behavior can independently drive short-term volatility regardless of what's happening with actual physical supply and demand is important context for interpreting any single day's or week's price action without overreacting to it. So what are professionals actually watching right now beyond the headline price? A few things stand out as worth tracking based on everything discussed so far. First, the trajectory of COMEX registered inventory, watched not as a single data point, but as a trend over multiple weeks, since a single day's decline means far less than a sustained multi-week pattern. Second, the weekly commitment of traders report, which reveals how concentrated speculative positioning has become, giving a sense of whether the current move is more likely to be driven by durable physical demand or more vulnerable leveraged speculation. Third, and often overlooked, the behavior of the gold to silver ratio, meaning how many ounces of silver it takes to buy 1 ounce of gold. This ratio has historically swung between wide ranges, and periods when it compresses, meaning silver outperforms gold, have often coincided with broader risk appetite and industrial optimism, while periods when it widens have often coincided with more defensive safe, haven-driven demand concentrated in gold specifically. Watching which direction that ratio moves alongside the outright price can help clarify what kind of demand is actually driving the current move. There's a question everyone eventually asks, even if they don't say it directly: what happens next? The honest answer is that nobody really knows, and anyone claiming certainty about short-term price direction in a market this dynamic is overstating their own insight. What can be done responsibly is laying out the primary scenarios, along with what evidence would support each one, so that as new information arrives, you have a framework for interpreting it rather than reacting emotionally to headlines. The bullish case rests on the combination of factors discussed throughout this analysis: continued industrial demand growth from renewable energy and electronics manufacturing that doesn't reverse based on price alone, since manufacturers generally can't simply substitute away from silver's specific conductive and reflective properties in the short term, combined with declining or stagnant registered COMEX inventory suggesting real tightness in deliverable supply, combined with a macro backdrop of falling or stable to falling real interest rates that reduces the opportunity cost of holding non-yielding assets. If these three forces continue reinforcing each other, the case for sustained price appreciation, even if not in a straight line, remains sound. The bearish case, which deserves equally fair treatment rather than dismissal, rests on the possibility that current price strength has become excessively dependent on speculative positioning rather than physical demand, which would leave the market vulnerable to a sharp reversal if commitment of traders' data shows speculative longs reaching historically extreme levels. It also rests on the possibility that central banks maintain higher, for longer interest rate policies if inflation proves stickier than currently expected, which would remove the real rate tailwind discussed earlier. And it rests on the possibility that a global economic slowdown reduces industrial demand for silver specifically, since a recession that curtails manufacturing activity, electronics production, and solar installation would directly reduce one of the two demand pillars supporting the metal, even while safe haven investment demand might partially offset that industrial weakness. The neutral case, probably underrated in a media environment that rewards dramatic narratives over nuanced ones, is that silver continues its historical pattern of high volatility without a decisive resolution in either direction for an extended period, chopping within a wide range as bullish structural factors and bearish positioning risks keep offsetting each other, neither fully resolving until one of the underlying variables, whether it's central bank policy, industrial demand data, or COMEX inventory trends, moves decisively enough to tip the balance clearly one way. Based on the evidence walked through in this analysis, the structural case, meaning the combination of real industrial demand growth and tightening deliverable inventory, currently appears more durable than the purely speculative explanation because it's grounded in physical market mechanics rather than sentiment alone. That doesn't mean short-term volatility or even a sharp pullback is off the table, particularly if speculative positioning has become extended, which is exactly why watching the commitment of traders' data going forward matters more than watching any single day's price move. Structural tailwinds and short-term volatility aren't contradictory. A market can be supported over a multi-year horizon while still experiencing significant drawdowns along the way, and conflating those two timeframes is one of the most common mistakes investors make when reacting to a single headline. One more piece of context is worth adding before wrapping up. It explains why COMEX specifically, rather than the broader silver market, keeps coming up in this conversation. The COMEX isn't just one exchange among many. It's the dominant price setting venue for silver globally, meaning the price discovered there effectively becomes the reference price used in physical silver transactions worldwide, from bullion dealers to industrial supply contracts. That centrality is why its inventory data carries outsized informational value. It's the mechanism through which the entire global silver price gets set day to day, not some niche corner of the market, which is why professional analysts watch its internal mechanics so closely, even though the general public rarely hears about registered versus eligible inventory, delivery notices, or open interest until a moment like this one, when a price level breaks and people start asking why. So where does that leave an investor trying to make sense of all this? Probably with more informed uncertainty than false confidence, which, oddly enough, is a better place to be than false certainty in either direction. The evidence supports taking the structural tightness signal seriously as one legitimate input among several, without treating it as guaranteed proof of an imminent supply crisis. It supports understanding that macro variables like real interest rates and dollar strength will likely continue to be the dominant drivers of precious metals prices over any medium-term horizon, meaning silver's path forward depends substantially on decisions being made in the bond market and by central banks, not solely on what's happening inside COMEX vaults. And it supports recognizing that historical episodes like 1980 and 2011, while useful for understanding how speculative excess can unwind, aren't perfect templates for a market with meaningfully different industrial demand characteristics than either of those earlier periods. The question worth carrying forward from this conversation isn't simply whether silver will keep rising. It's a more useful question: which of the forces discussed today, industrial demand, COMEX inventory trends, real interest rates, dollar strength, and speculative positioning, will you personally watch going forward to update your own understanding as new data arrives? Markets reward people who keep asking better questions far more than they reward people looking for a single confident answer. If this kind of evidence-based walk through how a market actually works was useful to you, consider leaving a like. It helps this kind of long-form analysis reach more people who are tired of headline-driven noise. And if you want to subscribe, this channel will keep digging into these exact mechanics, the parts of the market that don't make flashy headlines but actually explain why prices move the way they do. There's another video linked that goes deeper into how central bank policy specifically transmits into precious metals pricing, a natural next step from everything covered here. Thanks for staying with this one all the way through.